Okay. Okay, good people, let's settle down so that we can start. So we hope to finish this session punctually at 1 p.m. Chris took great joy in asking the private sector economists for a change questions that they ask us. I take great joy in asking the governor some hard questions. You all know the panel. I'm going to make it as informal as possible. I want it to be a chatty conversation. Many of them received some questions. I'll simplify it and cover these. Just by way of introduction, seeing that we spend a lot of time at conferences, there are two interesting phrases I've learned at conferences. The first is, the future is not what it used to be. And that's what we are going to talk about. The second is that monetary policy is neither a science or an art, it's a craft, which I think is an interesting way of looking at it. While the theme of our conference is 25 years of inflation targeting, Ben Bernanke gave a keynote lecture at the New Zealand 35 years of inflation targeting conference recently. And one of his big arguments from the inflation targeting was that, that the key lessons from the recent experience was really about how communication is put together and how great a weight should be put on the possibility of different outcomes beyond model expectations. I think that came out in Don's talk and many others. We've also learned in the last 2 days that 2 episodes stress-tested inflation targeting. The one was the great financial crisis and how we think about financial conditions, financial issues, how inflation target was somehow insensitive, or maybe the bank is not the target, not the inflation framework, to financial conditions and expansions in the financial sector. And the second was really the COVID episode, and there were many discussions about this. The other thing I guess we learned is that we're operating with monetary policy in a highly inflated, elevated fiscal stance in many countries. And what we also learned from the presentation in the last 2 days is that inflation targeting was largely a system of communication. That has become more and more important as it evolved. We had very interesting discussions on what the optimal inflation rate were. There were many issues around the exchange rate, how we think about sacrifice ratios, and the expectations channel. So what I wanted to ask our panel is kind of, maybe having spent 2 days at the conference, or 1.5 days, what really are the most important issues that emerge for you that you would like to kind of maybe debunk, amplify, confirm, that you think is important as we're thinking, as we're getting towards closing the conference? I'm going to start with Lisecha and I'll move that way.
I thought that you were going to end with me because there is a problem in central banking.
Yeah.
And the problem is that once I have spoken, the others are going to say like the governor said.
Okay. So,
Thank you very much. I think that for me, there have been a couple of takeaways. One is that the current inflation target is not consistent with our price stability mandate. That's given. And so there was a deputy minister of finance who, in his first 2 weeks in office, said that this inflation target was introduced in 2000. It's high time it get reviewed. And I called him and I said to him, yeah, I agree with you. And if the inflation target has to be reviewed, it can only be reviewed in one direction, lower. I didn't hear from him for 3 years. That is, for me, it's the second thing that I said, which I think I had previously mentioned, but was not coming forth, is that there are huge fiscal benefits in having a lower inflation target, especially if that target is achieved. And it's something that we have not communicated to say that actually this will release resources that government actually requires. The third, which sort of like I'd heard, said, well, if there are no costs to lowering the inflation target, why are we here? Well, we are not just here to discuss the costs of lowering the inflation target. We are also here to discuss the benefits of lowering the inflation target. And as it all happens, we must make a decision about whether the benefits outweigh the costs. And from what I have heard over the past 1.5 days, is that the benefits outweigh the costs. We have had a big thing called the discussion about the sacrifice ratio. And one of the things that apparently had come is that these chaps in the Reserve Bank mislead me because they understate the sacrifice ratio. So they came with a sacrifice ratio, and their sacrifice ratio was like 0.5, only to be told by Philip Berger that they are talking nonsense, that the sacrifice ratio is actually 0.3. Right? So these chaps in the Reserve Bank, they overstated the sacrifice ratio only to discover that actually there are people who think that the sacrifice ratio is lower. But you never win as a central bank. They are still accused of understating it, in spite of what the other work actually shows. The fourth point is, economists have got an optimization problem. So we are always looking for something optimal. And yesterday I picked on ZAFA, but one of the first projects I had in the Reserve Bank in 1994 was to work on a project on the optimal level of reserves for South Africa. That debate is still raging in the Reserve Bank 30 years later. That debate is still raging. When we had to introduce the inflation target in 2000, there was a huge debate about what the optimal target would be. And what are we doing now? 25 years later, we are discussing what the optimum level of the inflation target is. And like the previous panel said, I think now it's time. Make a decision, tell South Africans what you want to go and target, and do it. And that, for me, then brought the next question. Do we glide, or do we just announce and say, this is what the target is? I think the gliding is very attractive. And because it is said, you say you will go through this thing. And there's the one country that did it across the Atlantic, South, Brazil. They are on a glide path, and they are advising against it. But they are on a glide path already. But they are advising against it. And a couple of problems. I think that we forget that South Africa had a glide path. We introduced inflation target at 3.3 to 6, And then we said, we are going to lower it to 3 to 5. And an agreement between the minister and the governor said that after that, we will take it to 2 to 4, but we will not announce the 2 to 4. We will only announce the 3 to 5, and let's see what happens. Some country somewhere in Latin America decided that it's a cool idea not to repay its debt. Financial market crisis, emerging markets are in crisis. We reviewed the target and we said at an appropriate time we will reinstate the target. Minister changed, governor changed, we never went back to the target. So there is a danger with the glide path. Governor could change, minister could change, and as I had learned in the Reserve Bank, people set very good targets with timelines, except that the deadline is after their retirement, which means that the thing never gets to take place. So I'm looking at 5 years now. If we put 5 years, that takes us to 2030. The governor is gone, the minister is gone, the president is gone, and you know what? Another group of people will say, let us revisit this thing and establish what an optimal level of the inflation target is in South Africa. So that, for me, is that we are going to have to make a point and such that in 3 years, in 4 years, in whatever the time, but this is the target, and then we will have to go through it. So that means that I'm going to have to spend a lot of time drinking coffee with my colleague, the Minister of Finance.
Thank you very much. Before I move to Swati, let me just say hello to Ofanidis, Asunacho Ofanidis, who was meant to be here and for personal reasons could not join us, unfortunately, in Cape Town, and we'll come to you. But welcome, Asunacho. Let's go to Swati.
Perfect. It's hard to kind of top that, what the governor has just said. So I'm going to actually start. I was going to say something else, but I think I'm going to react to what I've heard about the South African inflation targeting question. I found the discussion in general absolutely fascinating. It's almost like seeing something start from its inception and how that might be carried through. I did sort of come out with I came out in agreement with what Mama Kete had to say in the last session, which is to say that it's not obvious to me. I can see the price stability question being important. I can also somewhat believe that, yes, 4.5% is not necessarily consistent with price stability, but somehow 3% is, and it's not obvious to me whether that 1.5% is enough to get me off the barrier of what is price stability and what is not. So I think articulating that and what the benefits are would be really useful. But I think it's really important there to stress what the long-term impacts are versus what the short-term losses might be. So I'm going to push back a little bit against some of the discussion that's come out. So you did say debunk some of the things. So one of the issues I keep hearing, and I've heard it multiple times during this conference, which is people dislike inflation. They really dislike inflation. Well, if you tell me I would get more purchasing power, yes, of course I want more purchasing power. But if you tell me that that could be under the veil of ignorance, I could be the one getting unemployed if one of the issues with that is that there is a serious sacrifice ratio. I may have a very different answer then. So I think the losses that come and the costs of inflation, both on the side of price stability, which is what it might harm, what harms it might do, particularly at the lower end of the income distribution, are really important, but also having the sensitivity to recognize that there are other unintended consequences as well as intended consequences if what you're trying to create is lower activity in the economy, that does have consequences for some people. And I think those need to be acknowledged. And I wish more research would get done which actually address the trade-off as opposed to just asking people, do you dislike inflation? Well, yeah, of course I dislike inflation. So that's one issue. And the second thing, which I think Andreas raised early on, Andreas here, which is that, what are the costs of inflation asymmetric? I'm actually not fully convinced that they are asymmetric. I don't think we necessarily have great evidence for that. And if anything, that's the reason places like the UK have a symmetric target. But for some reason, as policymakers, yes, we get a lot more anguish and a lot more pushback when inflation is high as opposed to when inflation is low. So is it us internalizing that political economy that's causing it, or is it really genuinely that the costs of inflation are higher when it's on the way up as opposed to the way down? We've had sort of almost 15 years of, at least coming from the UK, very, very anemic wage growth, very, very anemic productivity growth. And in that sense, is that loss, once you stack it up and what that's done to generations, to a whole generation of citizens, whether that stacks up with a temporary increase in inflation? I'm not trying to say that this is where I stand, but I want those questions sort of addressed in a more direct fashion. I'll stop there.
Thank you, Swati. Don?
Great. Thank you, and it's been wonderful being here and listening to this discussion. It's been great. I think picking up on the governor's benefit cost situation, I do think we probably don't actually know or are able to quantify the benefits, the net present value of all the benefits of operating at a much lower inflation rate. One, and I pick up on the Volcker-Greenspan definition here, where households and businesses don't have to worry about what don't have to take it into account when they're making decisions. I think there's probably considerable efficiencies at that, and they're really hard to quantify. I was a little, the emphasis in some of these discussions on the cost, on the sacrifice ratio, I think is is overdone, because I think the benefits over time, the stability in the economy, lower inflation rates or more stable inflation rates, at least that's been the empirical evidence. So I think I welcome and support the idea that the target ought to be reduced from 4.5 at least to 3 anyhow. Let's get it down there. I do think the way it was done in the U.S. bears some thinking about here. So as I noted yesterday, Paul Volcker got inflation down from double digits to about 4 to 5, and then it was a gradual decline after that. And it was gradual because there was the asymmetric response. There was very aggressive action to prevent inflation from rising and preemptive action to prevent inflation from rising, then acceptance, this opportunistic thing when inflation actually came down without necessarily the central bank pushing the economy into recession to make that last point. And I think that's worth thinking about how to do that. Another reaction, there's been so much discussion of other policies and how they could help monetary policies get inflation down. And I must say, interesting if Athanasios reacts to this, reminded me a little bit of Arthur Burns in the 1970s. So there were always 8 reasons why the Fed couldn't get inflation down. Fiscal policy wasn't cooperating, unions weren't cooperating, wages were indexed, et cetera. And he said, our job is to produce price stability, to protect the value of the currency that people carry around. We are going to do that. He was convinced that the present value of all the benefits from that far outweighed the costs. And if other policies cooperated, that was fine. But if they didn't, the central bank was going to do what the central bank was supposed to do. So I think a little bit, yes, there will be, since the government is a huge net debtor, there will be some transition costs from lower inflation to unexpectedly lower inflation. But I think you've got to ignore that and just do it, just go. Or there'll always be some reason that it does. And it'd be great to get cooperation from the government on the admin prices and things like that. So that would help, but it shouldn't be shouldn't be a necessary condition for moving. So one of my takeaways here is that there was maybe too much focus on having to have other government policies align with the central bank policy.
Thank you, Don. Jose?
Thank you very much again for the invitation, and it's a pleasure to be here in this panel. I will take a couple of minutes to talk about the Colombian case that I think that has some lessons in this discussion. Colombia was a country with 30 years of moderate inflation in the definition of Dorbush and Fisher, inflation between 20 and 30, relatively stable. Create a lot of inertial mechanisms, indexation mechanisms that create inertia from coming with the crawling peg and minimum wages and many things. Many prices were indexed to previous inflation. So it was a difficult situation to go down and to move from, let's say, an average of 25 inflation per year to a definition of price stability that initially it was not announced. But then when inflation went down, going down, and moved to one-digit inflation, about 9%, it was announced that the definition of price stability was inflation of 3%, with plus minus 1% in a range of 1. And the idea was to say, okay, we are moving in that direction, but we are not going to move. We are not going to move from 9.3% to 3% next year, because all of these things. And I think people understood very well that. And the inflation, the moderate inflation, created the sensation to the public that inflation was not harmful. That it didn't have too much problem. People want to live with inflation between 20 and 30 because they don't feel much pain with inflation. But when inflation went down to move close to 3%, to the long-term target of 3%, the public support is huge. It's huge. And it has become something in which if inflation goes up, many critics sometimes goes up, has been going up because supply shocks, and as I mentioned yesterday, for example, in periods in which you have a Niño phenomenon and the price of food goes 15-20%, and that creates 2-3 percentage points increase in a short period, 2 or 3 percentage points increase in inflation. The society immediately respond. And of course, the central bank is criticized by the government, and in particular by the president. When I was governor, in many occasions, we was very much criticized. And immediately, newspapers, everything was supporting the position of the central bank. So I say this because it's when you get something that, and my intuition is that an inflation target of 4.5%, moving to 6%, maybe not create that. But in our case, that 3% is like magic for support. So that's one point. And the other thing is, you never have the right conditions to move to reduce the inflation target. You may say many things that they are going to have X or Y actions in some other areas, and that is not the perfect time. You never create it, I think. And that is valid for the fiscal side. If the fiscal side is very, if it is something unsustainable, but that's one thing. But if it is not clear and sustainable, you may have room to do it, despite of the fact that you have precarious conditions in the fiscal side. And one thing that I learned at that moment was in the law, in the Colombian law says that you have to have coordination between the government and the central bank. And it looks very, very nice, but it's very tricky. It's very tricky. When you wanted to coordinate fiscal and monetary policy, the central bank is in bad conditions, because the coordination is, if the fiscal authorities are doing the right thing, you don't have to coordinate. Everyone can do their job. And if you don't have the fiscal conditions okay, the coordination is it's worse. It's worse. So what you need is to put some clear framework and basically to help. For example, we support the fiscal rules and the councils of fiscal councils and so on in that conditions, but not a coordinate, because the attempt of coordinate is always you do this and moves in the opposite direction that you want for the monetary side. So that was.
Thank you very much, Jose. Let me go to Atanasio. As many of you know, that his first connection with the debate in South Africa was that he co-published a UN wider paper with the ex-governor of the Bank of Ireland, Patrick Honohan, on what should South Africa's inflation target be. So Atanasio, welcome, and I'm sorry you couldn't join us in Cape Town.
Thank you, Chair. So it's really a pleasure to be with you. I'm sorry I'm not there with you physically, especially after hearing how great the weather is in Cape Town in yesterday's sessions. So let me actually start by noting one of the main conclusions Patrick Honohan and I had 3 years ago when we worked on the study for the National Treasury evaluating monetary policy in South Africa. I'm going to just read it out for you. The current definition of the target, a 3 to 6% band, is not ambitious enough and significantly reduces the benefits that the inflation targeting framework could otherwise provide. And let me elaborate a little bit on this, also accounting for many of the elements that were already discussed yesterday. I will focus on what the governor mentioned before. In our profession, in economics, sometimes there is way too much emphasis on trying to optimize and fine-tune things and figure out exactly what the right number is. And practical economists know that this misses the point. The question is, how can the central bank deliver price stability so that there is a stable environment that helps the economy grow, keeps government financing costs low, and promotes well-being overall? This is the main question. And if you go back several decades, an argument was made that it doesn't matter really if inflation is on average 2% or on average 5% or 6%. What really matters is whether inflation is stable. But there was a discussion that, as Don mentioned a few minutes ago, actually has moved us away from that. As Arthur Rockman had noted in a beautifully written paper in the 70s, there is no such thing as steady inflation. He called steady high inflation a mirage. And this is what we need to realize. In order to manage to have the benefits associated with a stable environment, we need to have low inflation. 3 to 6% is just not low enough. Now, on the cost-benefit calculations, many arguments were noted yesterday. I want to add something that I have to say I did not in session. Maybe it was noted here, but it was not noted yesterday. And this is the following. In one of the costs that are sometimes mentioned for reducing inflation towards 3%, which I think is appropriate for South Africa, on the way towards 2%, which is the global standard down the road, of course. One of the costs that has been noted is that bringing inflation down would increase the cost of financing of government debt and have these adverse fiscal monetary interactions. And I think this is misguided. The opposite is true. One of the benefits of the central bank delivering low and stable inflation is that in this way, not only nominal interest rates are, of course, lower, we all know that, most significantly by keeping inflation more stable, which can only be done if the inflation target is low, the central bank can actually enhance stability of expectations of future inflation, reduce the premium associated with future concerns about variable inflation, and as a result, reduce the real cost of financing of government debt. So to me, this is an element that is often missed in the calculations. There is a fiscal benefit. There is a permanent fiscal benefit in reducing the inflation goal to a low and stable number. The case of South Africa, again, 3%, because by doing though, the variability of future inflation is significantly reduced and premia have to go down. So in my view, this is one of the elements that are, as many others, missing from optimization calculus that many economists are running in simplified models, but it is of first order practical importance, and this is where we need to focus on to get the most out of what the central bank can contribute to society.
Thank you very much. I'm going to go around now. I'm not necessarily going in order, but I guess one of the questions is that, we've all said that you can write papers and say that we've heard someone say that the optimal inflation rate for South Africa is 2%. We've had someone say it could be 4%. There's a convergence on 3%. I guess what I'm going to start off with you, Athanasio, is what is the stylized facts of why you'd think that inflation should be 3% in South Africa at this stage of its development and 2% in the US? What is it about the South African context that lends you to propose 3% rather than 2%? And I'm thinking about some of the issues that Rafet raised yesterday about what is the notion, why is an emerging market different from a developing country? So I mean, I'll start off with you and then maybe get reactions from the rest of the panel.
Sure. This is one of the elements that I think were nicely discussed yesterday. I have to say that I agree with Rafet that we need to be it's much more important to be distinguishing dumb and smart countries, and all of us would want to give advice. South Africa should be among the smartest countries. So what does this mean for inflation? Well, if a country is not quite at the frontier of economic catching up to the frontier, productivity would be expected to be higher than that of major trading partners over the foreseeable future. And for that reason, it is sensible to have an inflation target that is slightly higher than that of advanced of more advanced economies, so that the nominal exchange rate can also be more stable. We know that even though inflation target is a wonderful framework, it's always better to have a stable exchange rate without intervening in that market associated with it. And the slightly higher inflation target than more advanced countries allows a country that is catching up still to do this. Now, looking at the data in South Africa, I would hope that with good policies going forward, productivity growth will be significantly higher than that of the richest economies on the planet. And this is why I would say that as a transitional measure, let's say for the next 10, 20 years, even 25 years, I'd be willing to say 3% would be the right target. But then eventually, I think the definition of price stability that I also consider useful is the one that Paul Volcker and Alan Greenspan were describing. It has to be so low that businesses and households don't have to think about it at all. And 2% is a better eventual definition of price stability by that account.
Thank you very much. Does anyone else want to respond to this particular question before I go to another question? Let me, thank you very much for that. So I'm conscious of time, and I will open it up soon. I want to ask maybe, so we've had this discussion about South Africa. I want us, maybe to be more forward-looking and global on what are the challenges that central banks face today. Don talked about operational independence. Everyone's worried about what would the role of a central bank be as fiscal challenges abound, issuance by governments increase considerably. There is the challenge of climate change and how that's going to affect relative prices. So we've learned from using balance sheets as an extension in both COVID and so on. Let me kick off with Don, and I'll come back to I'll end up with Lisetja. What worries you about if you take a forward-looking view of central banking? What are the issues you think we have to focus our mind on beyond just inflation targeting?
Yes, so I do think that we're likely to be in, and partly because of the president, my colleague, my people in the United States elected, not me, but likely to be in a much more volatile world with tariffs, non-tariffs, et cetera, at least for a short time. And I think the operational independence is so important to give the central bank an opportunity to look through what needs to be looked through and not look through what shouldn't be. I do think there are going to be some very difficult judgments that need to be made over the coming couple years about how to get to the 3% target in a durable way. And it's going to require relating the short-term situation to the long-term situation and telling the stories about how they're related. So I think a big challenge is going to be disruptions to global trade and less efficient allocation of resources around the world, and using tariffs to bludgeon other countries into doing things you want them to do. And that's just going to require a bunch of really difficult judgments. So the independence is critical in that environment.
Yeah. Sorry, anything here?
I'll add something on both independence and a little bit touch on what Don is saying. So I think, in the UK, I entered, and the next day after my first vote was actually the LDI crisis. So I think it was a very close moment of having seen what people's views of us not being operationally independent could do. And I think the fact that the bank had a program in place quickly enough, it was temporary and targeted QE that happened for a short period of time, I think really did restore credibility in the institutions. And I'm going to sort of push back a little bit against what Refek said, which is that, I think what distinguishes emerging markets versus advanced economies primarily is the fact that those institutions are in place. And sure, some advanced economies might slide into having institutions that are emerging market institutions, but overall, that institutional framework has to be in place to be able to do certain things versus not being able to, having the autonomy to do other things. And that being said, I think what I found really fascinating about what Refek showed, his prime example was Switzerland. And I've mentioned this to a couple of you, that the reason Switzerland managed to keep inflation low at a time period when almost everywhere in the euro area we were suffering from almost double-digit inflation was that there were price controls that were put in place. So that means, this is not just about having operational independence, but it's also about recognizing that there are certain limits to the tools that we as monetary policy makers have. And there are times when certain other institutions will have to step in to be able to control the situation. And both Switzerland and France ended up with good outcomes as a result of that. So I think, and I don't mean it that should somehow operationally compromise our independence, but it should be about having a framework in place where automatic stabilizers from other parts of government kick in as well. And I think we tend to be very focused on using the one tool or the two tools that we have at our disposal. And I think the conversation needs to become much broader if we end up in a situation where the world looks a lot more volatile, looks a lot more unpredictable compared to what we've been dealing with.
Yeah, that would be interesting. I mean, Rafat is not here, so I have to protect him. So I got invited to speak at a celebration of the 20 years of the independence of the Bank of England. And I didn't understand why I was being invited there. Talking about institutions, and you're saying that that's what distinguishes emerging markets from advanced. And it turned out, the reason they invited me was that the South African Reserve Bank was made independent before the Bank of England was. So this thing about institutions is not an emerging markets developed economist thing. And I think that importantly for me is that institutions are under stress, they are under attack. And when institutions are being undermined and are being under attack by people with populist rhetoric, the reason why those people with this populist rhetoric succeed is not because they are so powerful. It's because the good men and women, the Democrats, are not standing up to protect the institutions. That's the first point. The second point that I thought I would have, since we're talking about this, is about communication is important in a central banking environment. And there are people probably watching who do not understand these things about the sacrifice ratio and all of that. And Swati makes a very important point that maybe if you say to somebody, well, the sacrifice ratio here is that in order to bring down inflation, you might end up being unemployed, and maybe the person will think differently about that. I want to put it in a different way. The advantage of being a governor is that people send you messages when you are sitting on the panel, so you appear clever than you are supposed to be. The point here is, Don made this point yesterday that said that prices in the US will double in 36 years with an inflation target of 2%. And people would see this. So someone just did this number for me and said that a loaf of bread, 19 rands 99 today, he checked at some supermarket, and he said that, at an inflation target of 4.5%, that loaf of bread will cost 60 rands by 2025. That's the sacrifice ratio that an ordinary person will understand. And at 3%, that same loaf of bread in 2025 will cost us 42 rands. And so when we talk about the sacrifice, people talking about you are giving up output and because you want to bring down inflation. Well, it looks like for someone out there, it's about giving up the bread. And it is the responsibility of the central bank to protect that one because they do not have a means of protecting themselves against that. So I just thought that I will bring this to the forth as a point. Lastly, Rashad, there was a conversation earlier on about administered prices and how we might have to bring down inflation significantly in the private sector so that we can meet the target because the administered prices are remaining that. I want to push back on this because we are approaching it as if we do not have control of the administered prices as a society. And so we cannot have low inflation because we are refusing to tackle the challenge of administered prices. And we should actually be tackling that. But even still, just by emphasizing that we are aiming for 4.5% and not 5.99, which is what we were known for prior to 2017, is that administered prices, price inflation started to decline after we said that we are aiming for the 4.5%. And for next year, we are looking at 5.9. For 2027, we are looking at 5%. And this is administered prices excluding the cost of fuel. So I am saying that we shouldn't say we can't bring the inflation target low because administered prices are so stubborn. We should be saying to bring the inflation lower and stable, we are going to aim for a lower target. And do you know what? We need a different engagement with administered price setters so that we can benefit from low inflation.
Thank you. Jose, anything on your side?
Yeah, I share the point that the way that I see the main challenge is it may be related with the independence. In some governments in the region, they don't like very much the independence of the central bank. And the vaccine of that is the support of the society, as I said before. This is something that is a key challenge. But if we are talking about the challenges for the inflation targeting, for the framework of inflation targeting, there are many. One of them, what we have seen, those sequence of negative supply shocks are difficult to handle because we were prepared thinking in another type of shocks before. Uncertainty in the monetary policy transmission with changes in the structural changes, for example, in the labor market and so on. Things between the relationship between interaction of monetary and fiscal policy may sometimes create challenges. And forecasts. The forecasts are failing in many occasions because you receive shocks that you cannot imagine the type of shock that we receive. But in that type of challenges, I think that the inflation targeting framework, you may have some adjustment, you may have some consideration with the fiscal financial stability, etc. But the inflation target is really strong, I think. And it has shown that it has been very, very, very strong, the inflation target. And in my presentation yesterday, I put a series of shocks, huge shocks, all of them. And we did it very well. So.
Thank you. I'm going to ask a question to Atanasio, and then we can open it up. Atanasio, from time to time in the conversations the last 2 days, neutral interest rates reared its ugly head. And do you think that if we come to the conclusion that our own neutral rate has increased, effect of a number of things, do you think that conclusion is independent of how you think about the inflation target, that they're two fundamentally different issues? Or do you think your view about how the neutral interest rate has moved has an impact on the way you think about the inflation target?
Well, I'm going to go back 30 years to ask this discussion because I recall when I was working for Don, actually at the Fed, the Bank of Japan started having the problem with too low interest rates, and we started a series of studies at the Federal Reserve to prepare the committee. How do we think about the correct definition of price stability so that we can protect the economy from being in perpetually zero rates? So I have to say that my views about the appropriate definition of price stability have changed from between 0 and 1%, which is what I thought 30 years ago, to 2%, which is what I consider to be the conclusion of taking into account the concerns about the zero lower bound. But I would not want to allow concerns about R star to be shifting our definition of price stability too much. In the current environment, with estimates of the equilibrium real interest rate increasing, I think that that is not really of particular relevance at the moment. I would not worry about this going forward. The other thing I'm going to say is that in the last 30 years, particularly since the global financial crisis, we have globally much more experience about using balance sheet policies when needed, and even slightly negative interest rates when needed. And I think those have also softened the concerns about a changing R star on monetary policy. Indeed, I'm gonna say one more thing to bring this to closure. In my view, there is way too much for who was so into the whether R star estimates have moved up by 10 or 20 or 30 basis points in order to figure out how to calibrate monetary policy and ensure that price stability would prevail over time. And frankly, I think there is something to be said for returning to that environment, emphasis on these unknowable concepts.
So, Atanasio, as you were speaking, the reception went out, and there's a call from my WhatsApps on my watch. I also get them, not only the governor. We lost you a little bit. Were you saying that there's overemphasis on our side? I think that's the part that we must slightly.
Yes, so I noted that in the last several years, there is, in my view, excessive emphasis on estimates of R star for calibrating policy. And I think that this is not necessary, and this does not necessarily lead to better decision making. And I gave as an example that if we go back 20, 30 years ago, there was much less talk about what the level of neutral interest rates are, and policy could have been, and in many cases was, better.
Yeah, thank you. Does anyone else want to respond to the neutral rates?
I'm neutral.
Yeah. Don, anything on your side?
The overemphasis on R star?
Yeah.
Yeah, so I actually agree with Athanasio's. I think, and remember what we're seeing in the Federal Reserve projections is long-term R star. So it's not that helpful to what monetary policy should be in the short to medium term run. And I think the Fed has been looking at their low long-term R star projections and saying, well, policy is really restrictive. Well, at least through 2024, it wasn't particularly restrictive. The economy grew very, very rapidly, etc. I have an anecdote about the zero lower bound and the 2%. So I was at a conference at Vanderbilt in about 2014, 2015. Paul Volcker was out there, and he raised his hand and he asked, why is your inflation target as high as 2%? That's not price stability. And I went into this long discussion about nominal interest rates and the zero lower bound. And his response was, if you'd only paid some attention to financial stability, you wouldn't be stuck at the zero lower bound. So I think that's a lot of wisdom, as usual, in what he said. We can't ignore, this came up very briefly in the previous section, we can't ignore the financial stability aspects, but we have a lot of other tools than monetary policy to deal with it. That's where Claudio and I have had discussions over a long time.
Thank you very much. Okay, let me open it up for questions from the floor. Any burning questions? Hania? And there, second question there. I'll take about three, 4 questions. Yeah.
Thank you to the panel for the information they gave in the session. My question is just taking it back to the initial inflation target, and when that decision was made to move to 3.5, then readjusted it again to 3 to 6%, and we stayed there for a while. Were there any lessons learned from that period and ever since then? And do you think that also the timing matters?
Thank you. We got one there, and then we got Isai another question there. On that side, yeah. Yeah, there, yeah.
Thank you very much. I suppose I have a question. You know, inflation targeting is a technical pursuit, and the inflation rate is a political economy choice. In trying to push the inflation target to 3%, potentially without fiscal support or preferences, are we concerned about sacrificing inflation or monetary policy independence? You know, it's not a God-given right that the monetary authority is an independent authority.
Thank you. This side. Okay. One second.
Thank you. Isaiah Mtlanga from RMB. First is to observe that I don't think in this room and outside the room there is a disagreement on whether lower inflation is good policy. There's general agreement. It seems to me the disagreement is about the sacrifice ratio to get that lower inflation target. But I think perhaps the discussion is too narrow in terms of in the sense that it focuses the sacrifice ratio discussion only on monetary policy, rather than looking at all the other macro policy spaces where there is a sacrifice to growth, and then we can then compare the sacrifice ratio for monetary policy, the sacrifice ratio for bad energy policy, for logistics policy, and then say, which one should we really be concerned about? I would think the sacrifice ratio for doing good monetary policy, it's a small cost than the sacrifice ratio of maintaining bad policy in other spaces. That perhaps may reframe the discussion of why this sacrifice ratio is so important. I would like to hear the reflections of the panelists. Thank you.
Thank you. Let's take one more question, then we can open up. Yolanda, in front. Yeah, the mic's on that side.
Thank you very much. So perhaps a question for Prof. Fernandes. It's around this issue on the zero lower bound. You've indicated that the tools to effectively deal with it is available to central banks. My question is, does that really hold for South Africa? And perhaps related to this is the interest I have in a paper that you wrote on Australia in 2023 around their issue with the zero lower bound during COVID. And I think pretty much hidden within the paper, you have a comment that their preoccupation with their band of 2 to 3, their tolerance band, and the lower end of that at 2, created part of the start of their issues as they went into COVID. And the recommendation was that they should focus on the 2.5%, which is the midpoint rather. So just a question around that and how that might be applicable to South Africa. Thank you.
Thank you. Atanasio, a specific question to you, and then I'll open up the rest of the panel.
Sure, and thanks for the question. This actually allows me to talk a little bit about the distinction between a point target and the band. So the RBA, the Reserve Bank of Australia, It's actually a great example of how to do policy. They've done a great job over decades, and unfortunately, their definition of price stability for 30 years or so was inflation between 2 and 3%. And for the longest time, the RBA was interpreting this correctly as aiming for the midpoint of the target. It's important to have a target in mind, 2.5 in their case, so that inflation expectations can be anchored and all of the associated benefits accrue from that. Unfortunately, in their case, for the few years before the pandemic, out of concerns that sounded to me like old-fashioned BIS concerns regarding financial stability, the central bank allowed inflation and promoted inflation to go to the lower end of the band instead of continuing to focus on maintaining the midpoint at 2.5%. And yes, this was one of the factors that pushed them to the zero lower bound a little bit earlier than they otherwise would have been. But the lesson there is about the benefits of sticking to the point definition of price stability, or if price stability is defined as a band, to focus on the midpoint of the band. So right now, when I look at the SARB, focusing, as the SARB has been doing over the past several years, in the midpoint of what the government has. Unfortunately, this midpoint is too high to get the most benefit associated with inflation targeting. The benefits would be much better if the target yesterday were announced to be 3% in my view. Now, would the South African economy be concerned? Should we have concerns about the zero lower bound situation in the next 20, 30 years? And I would say that that is extremely unlikely in South Africa. As I mentioned already, the interest rates in South Africa are actually higher. Part of this is because the risk premium associated with South African interest rate is higher than it has to be, and higher than it would be if inflation were at 3%. With a 3% target, South Africa would still be 1 percentage point above all major advanced economies, and it would be extremely unlikely that in the foreseeable future it would face a situation where it would have to push interest rates to zero. And even if it did, as I mentioned a few minutes ago, we do have experience now with balance sheet policies. We can have targeted temporary balance sheet policies and get out of this. Again, if you want to compare Australia and South Africa, I would say yes, get lessons from Australia. 2 to 3% definition of price stability is much better than 3 to 6%. But I would be very happy in the case of South Africa if 3% is adopted.
Thank you very much. I'm just going to rephrase, with the risk of distorting the three questions which were related. I mean, what I hear, so there's a question of timing. So what I hear is that it is very easy to present arguments about why you don't want to go to a lower target, fiscal concerns, a number of issues. But on the other hand, when Raghuram Rajan was governor of the Central Bank of India, Reserve Bank of India, one of his most important strategies were that in getting the Indian inflation target to be from 2 to 6, he wanted a free ride on economic reforms of India to bring down the cost of getting to a target which India didn't have. So at one level, what I'm hearing is that it's very tempting to make excuses about all the obstacles to getting the inflation target down. At another level, to be able to do it, taking Isaiah's question, when there's reforms, when the prices are declining because you're breaking up monopolies and so on, those costs are much lower. So I guess the question I'm putting out is, does timing ever matter, or that at the end of the day, you've got to do it when you have to do it, whatever the odds against you, whether the fiscus is coming to the party or not, or government's coming to the party, as a central bank, you have this obligation to really work on what you think should be the appropriate inflation rate. I know it's convoluted, but who wants to kick off?
I'm going to give a totally different view on
Yeah.
it, coming from growing up in India, which is that I'm completely in agreement with the governor here. There's always reason to wait and watch. There's never a good time to do anything unless you're somehow really forced to do it, and then you pay really short-term, sharp loss, costs for it. So in that sense, when you've got momentum going, that's the moment to do any reforms that you want to do. But that's a very general statement, having seen how it unfolded in India, where it was just absolutely dire circumstances and you just had to do some of the reforms. But the later reforms that came did have a fairly sort of straightforward path whenever there was political momentum behind them.
Yeah.
I think the timing issue is tricky because this is about credibility. So how do we lower the sacrifice ratio? We have credible central bank objective on, say, the 3% target, and you need to make that credible. So to Swati's point, if it's always some excuse about why it's going to be in the future, I think that undermines the credibility and raises the sacrifice ratio. On the other hand, I think setting out a year-by-year path that you're not going to be able to meet, given all the other things, will eventually undermine your credibility. So I think the credibility is built by having a clear goal and then acting very strongly to tilt the path down without having a specific timing thing that's going to be undermined. I think if I could pick up if I understood the question about fiscal policy and sacrifice ratio, I don't see that fiscal policy changes the sacrifice ratio. I mean, in order to get inflation down, you've got to have either good, favorable supply shocks or some decline in demand. And what fiscal policy does, aside from the admin prices, so I get that, but just the fiscal stance, one way or the other, isn't going to change the underlying dynamics of the labor market. It will mean, and it has a little bit of a risk that if you say, I can't meet this thing without fiscal policy cooperating, then fiscal policy doesn't cooperate, where are you? So I think I worry about, if I understood the question correctly, a stance that would say, here's our target, but we really need the cooperation of the fiscal authorities. I don't think you do. And it might be helpful, but you can't depend on them because they're going to be all over the place. It's got to be the central bank.
Mr. Jim, any on your side?
I think the one question that can only be answered by me, I suppose, about the lessons from the previous revision of the target. It was a terrible mistake. Terrible mistake. Announcement made, new target is 3 to 5. You experience a shock, we said we are going back to 3 to 6. And part of the problem at the time was the existence of the escape clause. And so we were very quick to pull the escape clause and said we have experienced a shock. The correct response should have been, the target is 3 to 5. We have experienced a shock. We will get to 3 to 5, but instead of getting to 3 to 5 in the next 2 years, maybe it will take us 3 years, but the target remains at 3 to 5. And in a way, when people talked about that light path and say, we talk about that light path and we say that, well, we will move from 3 to 6 to maybe 3 to 4, or and then eventually get down. And that therein lies the problem. You do not have to be having the path in order to glide there. Just announce the destination and say, that is where I am going, and I will get there over this period of time. If you experience a shock, that's what we deal with all the time. You experience the shock, you explain yourself that there is a shock, as long as everybody can relate that, yes, there is a shock, and because of this shock, you are deviated from a target and set a path to say, I will come back to the target by this time. That's a question which I'm not sure that understood about the political economy of central bank independence. It just sounds like from my trade union days. If you do not want to make a decision, you say there are big political economy questions that must still be answered. And we as South Africans explain that we want to talk some more, right? And we like doing that. And people talk about this burning platform, and sometimes South Africans, South Africans need to be facing a crisis in order to be making the hard decisions that were being referred to. I do not think that this one necessitates us having to wait for them. But that's the claim that central bank independence is not God-given. Yes, it is not God-given. But you know what? It's been constitutionally given in South Africa. In the same way that you wanted to have an independent judiciary and other independent institutions of our democracy. So institutions matter. And it's going to be very important that when the narrative changes, that we good men and women stand up and protect institutions. We have been there before. The SAP came under attack from another constitutional institution, and we had to rise up and protect the independence of the SAP because we believed it was a good thing to do, and not because we felt that we should be cowing away from that attack. And we would not be the only institution of democracy that would be under attack. Other institutions in our society had been attacked. The only thing, though, that if I would concern with the institutions is that if you want to destroy institutions, you do not have to be attacking the institutions. You just stuff the institutions with pliable individuals, and then you can just manipulate these people, and then they destroy the institution in that process. And you know what? There are checks and balances in a society. If there is a pliable individual there, at some point society will say, this individual is not living true to the constitutional prescription and therefore must be removed.
Thank you. Anyone else want to respond to political economy questions? If not, let's take another round. And I realize that we're reaching the point of diminishing returns. People are tired. We don't have to go on until 1, but happy to do it if people still have questions. So let's see if there's another round of 2-3 questions, and then we close it up. And it's been a long 1.5 days, I know. If not, I will have the distinction of saving us 15 minutes, which no other chair has achieved. But Atanasio, any last words from you? No, you good?
Let me actually, 15 minutes too early, way too early for me. It's not even 7 a.m. here where I am. So let me add something on the question regarding the sacrifice ratio and the costs. I agree with the speaker that the way we have been discussing the costs of reducing inflation, the inflation target and the focus on the sacrifice ratio is too narrow. And again, I would invite all of us to not lose sight of the massive benefit for growth for the next 20, 30 years. If the National Treasury were to announce tomorrow that the new definition of price stability for the SARB is 3%, with the credibility that this would create, the narrow concept of the sacrifice ratio would actually be zero, in my estimate. As we know, on the basis of macroeconomic theory, there need not be any sacrifice cost at all on stabilization purposes by properly announcing a credible reduction in the inflation target. So this is the narrow point. And then the broader point is that let's not lose sight of the massive benefits. Low and stable inflation makes it far easier for businesses to plan, raises productivity over time, and as I started an hour ago in my first intervention, reduces the cost of financing of government debt by bringing down premia, making the government's job so much easier for implementing other structural reforms, effectively creating a virtuous cycle, which is exactly what we would want to see for the economy to advance. I'm going to leave you with this thought.
Thank you
very much, and I'm sorry
He's
I'm not
taken your
there in
job.
person.
Summarize the conference.
Beautiful. Thank you for summarizing it at that early hour for you. Anyone else? No? Good. Thank you very much. And all, I don't know if you want to give some closing comments on thanking everyone.
No. Often it is closed. It's not
Yeah.
nice
So
for us.
thank you once again. From my side, it's very nice just to come here and expect a program and entertainment, and from all the teams, the research department, the CRIS, the other department, the events. Carol always, as you know, the SARB. One thing it does better than inflation targeting is conference organizing. It does in most countries, but thank you everyone for attending. It's really, really a robust discussion. The SARB can only become stronger when you have a civil society, academics, researchers, our networks internationally to debate really these important issues, and I think it was really, really useful. So let me take in my capacity this opportunity to thank everyone. And I hope that you have a beautiful rest of the day in Cape Town. Thank you.